Welcome to our channel. In the wake of the unprecedented global pandemic, the world finds itself at a critical juncture, grappling with economic challenges and uncertainties. Today, we will consider the complex landscape of the post-pandemic economy that we are now witnessing. Specifically, we'll explore how interest rates are used as a tool by policymakers to address various economic challenges, such as inflation, economic growth, and financial stability. Join us as we unravel the implications of interest rate policies, their impact on various sectors, and the strategies for navigating the road ahead in these unprecedented times. Let's start with the basics. Interest rates, set by central banks, determine the cost of borrowing money and the return on savings and investments. When interest rates are high, borrowing becomes more expensive, while savings earn higher returns. Conversely, when interest rates are low, borrowing costs decrease, encouraging borrowing and investment. Interest is the single most important feature in the capitalistic economy that separates itself from other economic systems. Capitalism is characterized by private ownership of the means of production and the pursuit of profit. Capitalism emphasizes investment and profit-seeking behavior as fundamental drivers of economic activity. It relies on market mechanisms to allocate resources efficiently based on supply and demand, with the goal of maximizing wealth and economic growth. This emphasis on individual initiative and profit motive has led to significant advancements in productivity, innovation, and overall prosperity in many capitalist societies. Over time, the overly competitive nature of capitalism also provoked the rise of socialism, which emerged in response to various criticisms of capitalism, including issues related to income inequality, exploitation of labor, and economic instability. Socialism advocates for collective or state ownership of the means of production and aims to prioritize social welfare and equality over individual profit. Instead of allowing the market to determine resource allocation, socialism often involves central planning or democratic control of the economy to ensure equitable distribution of resources and social services. In capitalism, individuals or entities invest capital with the expectation of earning a return on that investment. This return can come in various forms, including interest, dividends, capital gains, or profits from entrepreneurial ventures. The pursuit of profit incentivizes investment in productive activities, such as starting businesses, expanding operations, or investing in financial assets. One of the key objectives of monetary policy is to maintain price stability, typically by targeting a certain level of inflation. When inflation rises above the target level, central banks may respond by raising interest rates. This makes borrowing more expensive, dampening consumer spending and investment, which can help cool down inflationary pressures. While high interest rates can help combat inflation in the short term, prolonged use of high interest rates can slow down economic growth, increase unemployment, and strain borrowers who are servicing debt. Moreover, high interest rates may not address the root causes of inflation, such as supply-side constraints or excessive demand. In certain circumstances, the government may come to a decision that the interest rate needs to be enforced persistently high or low to address particular economic challenges despite an adverse economic pressure, which is currently happening in many parts of the world as a result of what the pandemic engraved on the global economy. If the interest rate inevitably needs to remain high under unfavorable economic conditions, it could only be practiced at the price of unintended consequences. While central banks have the authority to adjust interest rates, doing so in a way that overrides economic conditions and imposes persistently high rates against adversity can have significant repercussions. High interest rates can lead to financial strain, defaults on loans, and potentially systemic risks in the financial system. High interest rates can also attract foreign capital, leading to an appreciation of the domestic currency. This can negatively impact export competitiveness and worsen trade balances, affecting industries reliant on exports. Enforcing persistently high interest rates may face opposition from various stakeholders, including businesses, households, and policymakers concerned about the negative impacts on economic growth, employment, and financial stability. This could lead to political pressure or social unrest. Maintaining a balance between returns to capital and wages for labor is important for a healthy economy. When the returns to capital, or capital gains, significantly outpace wage growth, it can lead to issues such as income inequality, reduced consumer demand, and labor market distortions. If capital gains far exceed labor compensation, it could erode the willingness to engage in the labor and incentivize the shift from labor to capital investment. This can lead to labor shortages and wage pressures in the labor market while causing overcompetition and potentially speculative behavior in the capital market. Since the abolition of the gold standard, the global economy has experienced significant growth and transformation. The expansion of the money supply, along with advancements in financial markets and technology, has led to substantial increases in capital accumulation and wealth creation. Over the past few decades, there has been a widening gap between capital gains and labor compensation in many economies. This trend has been driven by various factors, including technological change, globalization, financialization, and changes in labor market dynamics. Capital gains often have the potential to grow exponentially over time, driven by compounding returns, investment strategies, and market dynamics. In contrast, labor income tends to be more directly linked to working hours or wages, leading to a disparity in wealth accumulation between capital owners and workers. Lowering interest rates can be the one most effective tool to address such disparities in wealth and income. By reducing borrowing costs and stimulating investment and consumption, lower interest rates can help support economic growth, job creation, and income distribution. Enforced high interest rates should lead to the opposite direction, exacerbating these disparities. The total supply of money is mainly determined by the reserve ratio, which means the proportion of deposits that banks must hold in reserve and cannot lend out to the borrowers. The money multiplier, which is defined as the inverse of the reserve ratio, determines how much money aggregate will be created as a result of the lending activities in the money market. The lower the reserve ratio, the higher the money multiplier, meaning that a given amount of reserves can support a larger amount of money supply through the banking system's lending activities. While changes in interest rates may not directly determine the money multiplier, they can influence the velocity of money circulation in the economy. When interest rates are high, individuals and businesses may hold on to money for longer periods, leading to a slower circulation of money and a lower velocity. Conversely, lower interest rates may encourage spending and investment, resulting in a higher velocity of money. It is important to note that the interest rates primarily influence the velocity of money circulation by impacting borrowing, spending, and investment patterns, rather than significantly altering the overall money supply. Ultimately, the central bank has significant influence over the money supply through its control of the monetary base, which means currency in circulation plus bank reserves, and its ability to set reserve requirements and interest rates. Central banks use various monetary policy tools, including open market operations, reserve requirements, and interest rate adjustments, to manage the money supply in line with their policy objectives, such as price stability and economic growth. Enforcing high interest rates to mitigate the money multiplication can be similar to administering a painkiller or antipyretic to alleviate symptoms, rather than addressing the underlying causes of the issue. Since the ultimate multiplication of money is basically determined by the money multiplier, or the inverse of reserve ratio, it is not largely affected by the interest rate. The moment when money printing or stimulus funding is administered, the ultimate expansion in the supply of money is bound to happen, no matter what the interest rate is kept at. While high interest rates may slow down the increase and help temporarily alleviate inflationary pressures by reducing borrowing and spending, they may not address the root causes of inflation because the ultimate money multiplication is already determined. The supply-side constraints, cost-push factors, and the excessive demand fueled by factors like excessive government spending or rapid money supply growth still remain unresolved. Moreover, prolonged use of high interest rates as a policy response can have unintended consequences and potentially worsen the economic condition. Persistently high interest rates can lead to reduced investment, slower economic growth, increased unemployment, and financial distress for borrowers, among other negative effects. Instead of relying solely on high interest rates to mitigate inflation, policymakers often adopt a more comprehensive approach that addresses underlying economic imbalances through a combination of monetary, fiscal, and structural policy measures. This might include measures to enhance productivity, increase supply capacity, address bottlenecks in key sectors, and promote competition. In conclusion, interest rates play a vital role in economic policy, particularly in managing inflation and promoting financial stability. However, it's essential to recognize the limitations of high interest rates and to adopt a holistic approach to economic policymaking. As citizens, it's important to stay informed about these issues and engage in discussions about the best policies to promote sustainable economic growth and prosperity for all. Thank you for watching. If you found this video informative, don't forget to like, share, and subscribe to our channel for more content on economics and finance. See you next time.